Welcome, and thank you for joining this panel, Success Stories Scaling Blended Finance. We meet at an important moment. In just a few months, world leaders will gather for the 4th International Conference on Finance Development. As we approach that event, many are asking, how can we use private capital to support development in a bigger and in a smarter way? Major donors are cutting their aid budgets. Most places, public finance is under pressure. And that does put blended finance in the spotlight. Can we blend a cocktail of capital with different risk-return appetites to help solve some of the world's biggest challenges? Yes, we can, but it's not easy yet. We need to overcome some barriers. We need to figure out how to scale impact investing through blended finance. So today, we are here to talk about what works and how to make it work even better. I'm excited to hear from our panel, a group of people who are leading the way already. But before I turn to the panel, I will turn to you, the audience, and ask you 3 questions. So, do we still have the card on the table? Yes, we have. It doesn't matter what color you use, just if you agree with my question, raise a card. So my first question to you is, how many of you do exactly know what blended finance is?
Can we play?
It's quite a lot, thank you. And my next question, how many of you have used blended finance in an investment? Less? All right, thank you. And how many are thinking of using blended finance in the future?
Raise your hand.
Yes, good. More? Thank you. So that's good to know. But now I welcome you, the panel, and I have been looking very much forward to this conversation, to hear your perspectives and your experiences. To kick things off, I'm going to ask the same question to the 4 of you. But Joan, I would like to start with you to help set the stage and to give us a shared understanding of the playing field. So before you do that, could you please just state your name, your organization, and your experience with blended finance? And after doing that, I would like you to give us a quick overview of how big is this, the current trends, the kind of impact it's aiming for, and where it is happening geographically. So please.
Sure, and good afternoon, everyone. I hope you've had a good lunch and good investor meetings. My name is Joan Larea, and I run a small, not-for-profit corporation out of Canada called Convergence Blended Finance. As you can tell from our name, all we do is blended finance, and we're a field builder in that field. We produce probably the best data out there, if I could say that, not so humbly, on what is happening in the field. We also try to guide practitioners, connect them to each other, and accelerate motion in the field. I thought I would, first of all, make sure, although I saw a lot of very confident hands, which heartens me, because 10 years ago, nobody would have raised their hand. So a lot of people think that they do know the definition, but let me just touch briefly, when I'm giving you statistics, what I'm talking about. Blended finance for us, because we were set up to try to accelerate the investment of private capital in the emerging markets. So for me, the definition is the use of catalytic money, the kind that comes out of an official donor agency or philanthropy or family office that's able to not act commercially. It's the use of that kind of money to draw in private sector money, like primarily what is in this room, all the blue cards this morning, that money, into transactions that otherwise wouldn't touch because the risk is not correct for the return is not correct for the risk being presented with the opportunity. So, with that in mind, what we saw in 2023, which is our most recent data for the moment, is that the field of blended finance clocked in at about $18 billion for the year. huge increase over 2022 when it was 8 million. So it went from 8 to 18 billion. The places or the types of investments we saw being made were financial sector, renewables, and agriculture, agribusiness as the top three, and then a spattering of other objectives. Africa continues to be the highest incidence of deals, followed by East, Southeast, and South Asia. If you look at the size of the deals, of course, you get a different picture, but the most frequent place is Africa. What drove that big increase? First of all, climate deals. Climate-related transactions were 80% of the money in the field in 2023. We also saw fewer transactions, but bigger median size of transactions. And in particular, we saw all of a sudden about 40% of the transactions happening were $100 million scale or larger. By the way, when I say transaction, could be a fund, could be a securitization, could be a green bond. All of those count in our world as a transaction. We saw a few whales, a few billion-dollar-plus transactions. And Timothée can talk to you about Amundi's work on that end of the scale spectrum. The money that was involved in the increase was primarily the development banks of the world and the private sector. We did not see an increase in official development aid at all. And we can talk about what we think is happening going forward, but this was not, the French government or the Australian government suddenly increasing their participation. This was your money that went in, which is pretty exciting for us. And in general, when we see large deals, they tend to mobilize more dollars of private money per dollar of ODA or catalytic money. So that's why you saw that jump, is we saw bigger deals and therefore more private investment. I'm going to stop there for the moment, pass the mic, but that's just setting the table for the rest of our speakers.
Okay, thank you so much, Joan. And for the rest or the four of you, we will start by focusing on success. So please give us an example of a success story with using blended finance that was not only impactful, but also scalable, and also what made it work. And Dolores, can I start with you?
Sure. So unlike the others in this panel, we're focused on developed countries. So I work at an NPI, National Promotional Institute of the Netherlands, InvestNL, and we have 2 billion assets under management. And last year at this specific event, we announced that we had an additional 1 billion attributed to our fund, and 250 million of that would be allocated towards blended finance, but that's all from 2026 onwards. So now I can kind of speak about a blended finance structure where we invested on more like the private side. So we were mobilized by what was also financially provided by other parties. And one example that I would have and I would like to share is Horizon, which is a MSR, so a small modular reactor, which is basically a smaller size nuclear plant, which uses a different technology and is able to use nuclear waste as another source to keep providing energy for its operations. And its funding was 20 million, so it was the second time they did a funding. And of that 20 million funding, 4 million of that was a subsidy from a province in the Netherlands, 16 million was equity, 10 million of that was InvestNL, and we were then backed by InvestEU by a guarantee of 50% of that amount. So you can see it's already quite a puzzle and quite a complex structure, but that allows this company to move forward.
Okay, thank you. Lev?
Yeah, thank
success.
you. Yeah, hi everybody. My name is Lev Plavis. I'm with Kiva, specifically with Kiva Capital. Before getting into the success, I just want a quick show of hands of who has heard of Kiva before, just so I know. And keep your hand up if you've ever made a loan on Kiva before. Great, so thank you all of you who have made a loan. Thank you all of you who will make a loan on Kiva. Kiva.org is a crowdfunding platform that allows anyone with a credit card to visit our website and make a loan as low as $25 to an entrepreneur somewhere in the world. And while that is what most people know Kiva as, fewer know Kiva Capital, which is our asset management wing, which we launched in 2019. And that's the side of the company that I'm sitting on, and that's what I'm going to be speaking about most today. The example that I'm going to touch on is not going to show up in the 1 billion whales that Joan talked about, or on the list of kind of thematic sectors that you see a lot in blended finance, but it's investing in refugees, which is still incredibly nascent and not an area that many are looking to move into. In 2021, we launched the Kiva Refugee Investment Fund, or KRIF at Kiva, which is a $32.5 million blended facility, raising $11.5 million in LP capital from a diverse range of LPs, from foundations, family offices, faith-based individuals, high net worth individuals, and then leveraging that to borrow $21 million in public and private debt. So that base of kind of really diverse LP capital is what allowed us to reach the scale that we needed. So that blended model was key. I'm also going to spend some time, and I'll do this when we come back to this, talking about how our philanthropic Kiva.org side was really key in using that blended aspect of the philanthropy to get to where we are with the Kiva Refugee Investment Fund today.
Thank you so much. And Timothy, your success example?
Sure. So perhaps to focus on one of the wells that Joanna has alluded to. So the rationale at the time was to focus on green bond. We thought that was like 8 years ago. We thought that green bonds were great in the sense that they had very standout financial features.
Yep.
It is a fixed income instrument. All investors in the room have probably exposure to fixed income instruments, bonds, one way or another, combined with impact features. We had transparency, we had intentionality, but back in the day, there was a big question mark in terms of the additionality. If you only had European Investment Bank issuing green bonds, there was an issue because they were going to do good things no matter what. And we thought there would be great potential to increase additionality if you expanded the kind of green bond issuers you had. And so we were selected by the IFC, which is part of the World Bank, to launch an investment program to support the development of green bonds as an asset class in emerging markets. So they had 2 legs, basically. Number one, a fund, $1.5 billion, 3 tranches, junior for MDBs, mezzanine for DFI and philanthropic organization, and senior for mainstream investors. 90% of the 1.5 billion was drawing from senior. And you had a technical assistance program, basically $10 million geared toward training the future green leaders of the target markets. Effectively, emerging market bank staff going to Sweden, going to the Netherlands, going to France to meet responsible investors to understand better the market and what they were looking for so they can bring their knowledge back to their organization, to their country, and drive market change on the ground. 7 years after, we are 99% invested into emerging market green bonds. We started at 0%, literally, at start. 1 billion plus invested into green private placement, which means that effectively these were more primary issuances from first-time issuers in more difficult markets. And we were invested in 20 plus countries at the end of the 6-7 years. So that's, I think, a good example of a fund that reached scale already. Having said that, we should really focus on the challenges, and I'll close on that. If you take Amundi's overall AUM, 2.4 trillion, it's 1 trillion that we classify as responsible product and mandate. We have a 20 billion impact target with strict criteria in terms of intentionality, additionality, and transparency. It's 0.3% in blended finance. When we have launched other funds, but where I'm getting at is that if we want to crack that nut and have more wells and increase the AUM growth, we think we need to work better on standardization of funds, and we need to think as well at instrument level. And perhaps we can touch on that afterwards.
Yes, we will get back to the standardization. I hope we have time. Yeah. But Ashish, it's now your turn.
Yeah, thank you. Good afternoon, everyone. My name is Ashish. I'm representing Pension for Purpose, which is a UK-based organization working with a number of institutional asset owners there, trying to really integrate impact and mainstreaming it across the asset classes, and they're working. Having heard my co-panelists here, let me pick an example which is probably slightly building on, the kind of sort of areas you have touched on, and that is more out there in the market I've seen over the years. There's a VC fund called Equator Fund, which I was familiar with, and I saw coming out as an emerging manager and being backed. And when we talk about blended finance, a lot of time it's about de-risking, how do you use that catalytic capital to de-risk? There's one aspect which I believe needs a bit more nuance, which is around return enhancement potential, which is you can potentially build that through a bit more sort of different focus and motivation of the allocators. So in this particular fund, the way it worked out is it was standard tranches. However, there was in 40-50 million vehicle, there was 5 million set aside for return enhancement tranche, and that was thanks to the DFI, PII involved in, which were recognized that it's a emerging manager, it's in a market which is perceived high risk, and the specific structure there was anything preferred return. Well, there was a preferred return, minimum hurdle like 3-4%. But anything above that, if it's there, then this tranche going to be used for the sweetening it for the senior tranche investor. So that particular example of how you can also look at return upside for a lot of senior investors is not often talked about when we look at typical de-risking structures. So I believe we need more mainstreaming of some of those instruments.
Thank you. Dolores, you've done a lot of research. And in that research, what solutions do you find in the research projects to overcome some of the typical barriers for blended finance?
So another short jump to what we're doing at InvestNL that I didn't touch upon yet. So we have a fund which invests in with the mission to make the Netherlands more sustainable and more innovative. And we focus on scale-up companies or the end of the startup phase, mostly in projects or companies. But we also have a business development side. And that division has the same type of themes, also energy transition, etc., where we do research. And I'm part of the team that does also blended finance advisory work, and proud to lead some of those projects there. And one of the most recent projects there is the project that we did with Port of Amsterdam, which you probably all know, and is located very close by. And they're looking into importing green hydrogen through the Port of Amsterdam. And I've been working with Ecolog as well as with Tata Steel to look at that business case. And what we've done there is to research their business case and see what is the financing gap if you bring everything together. So basically just building a financial model, look at the inputs, and see where there's room. And then ultimately come up with solutions that could potentially bridge that financing gap, which is often the case in these blended finance structures. So how can we create some sort of financial vehicle that can close that gap. And here in this research project, which you can read also on our website or wherever you can find it, we discovered a few things. On the first hand, you can look at these contract for difference mechanisms, which are very well known. So one of the most successful blended finance structures in the Netherlands is the offshore wind sector, where there's been a big subsidy scheme for years and years. And the interesting thing there, a little sidestep, is that recently, in the last month, if you follow the Dutch news, you've seen that that business case is now becoming less viable again. And though the subsidy scheme has provided that necessary cushion for the private investor to step in. Now that business case is becoming more uncertain again because of mainly two big things. One, the costs are going up, and on the other side, there's this uncertainty in offtake from the industry. And the same thing goes if you look at the Port of Amsterdam business case. You have this high cost price in stepping away from natural gas, but going towards green hydrogen. It's just relatively more expensive. And on the other hand, you also have quite some uncertainty in who's going to create that offtake and that certainty for you to get those long-term contracts. And there we kindly found, this is a long introduction to the solutions. There we found three things. The first one is that it's very important to bring everyone together. So that's what Port of Amsterdam is doing really well with Ecolog and with Tata Steel and other parties involved, also a few German parties, to really discuss how can we all take on different risk, how can we kind of like set our expectations a bit lower maybe to bring this business case into a potential investment case. And then on the other side, the second thing that we also saw is that if an investment, if the government steps in, it needs to be really long term. It's a high, big investment in the beginning and then uncertain in the longer run. So you'll see that it doesn't pay out until way, way longer with these projects. So there it's very important to have these patient investors and to get the right people on board there, which is nothing new, but it's important to really state, okay, how long does it take in this business case, and how do these investors feel about that, and get that picture clear. And the last thing is also rules and regulation. We've had quite some discussions now with the government as well, is that besides blended finance and coming up with this financial structure, this rules and regulation part can really boost the certainty and then eliminate the uncertainty of the business case and make sure that it could be a viable business case. So those are some of the lessons from the project that I think applies to a lot of blended finance cases.
Thank you, Dolores. Before we take a little, or we deep a little bit more into blended finance structures and barriers, Joan, I would like to get your perspective on what does the current geopolitical situation means for blended finance.
Before I go there, I just want to make an observation about my fellow panelists' description of deals and transactions and work they're doing. There is a role for blended finance in being the first small transaction that needs patient capital that defines a new asset class or a new opportunity, like refugee investing. I hope in 5 years we're sitting here and we're all going, oh yeah, refugee investing, right? And then there's a role for blended finance in huge scale in getting the pension fund money in this room into very normalized looking things. So this is a continuum. You need the early stage stuff that you, Dolores, and you, Lev, are talking about in order to tee up that moment that allows Amundi to pull off a whale transaction. It all matters. I just think in this room we're probably more often talking about the standard. What do I see going forward? This is a pretty grim moment in the development aid world. There is not going to be a massive increase in development money or philanthropic money, no matter how much we hope for it. In fact, there's probably all in about $230 billion a year of official development aid going into the emerging markets, and I can imagine a $50 or $60 billion drop overnight. So we have to get more juice squeezed out of the orange. What does that mean? That means anybody who has any concession or catalytic money to spare, I'm speaking in part to all the governments of the world, you need to be incredibly smart about how you use it to galvanize private sector money to pull it to the table. That means don't reinvent the wheel. It means don't do deal number 3. It means standardize, 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 tee things up that are recognizable to Amundi's investors or the LPs in your fund, and serve that up and dose out, the squeezed juice from the orange very, very sparingly. We're not going to see huge increases in that kind of money. The good news is, like I said, last year we did see more juice squeezed out of the orange. ODA was flat, and the number of blended deals went up. So we need really small doses of that money in really smart ways, in very recognizable structures, and then we need to get off the blended finance drill and do non-blended deals as fast as possible. I think that's what the geopolitical situation tells me what to expect.
Thank you. And to build on what you said about the continuum of blended finance, Lev, my understanding is that Kiva has built a blended finance journey starting with philanthropic capital and scaling up through institutional capital in the Kiva Refugee Investment Fund. What lessons have you learned about moving from proof of concept to scale?
Yeah, it's a really good question, and I think when we think about the work that Kiva is doing in the refugee space, we started this work in 2016 on the Kiva.org crowdfunding platform, using people with a credit card putting $25 on the platform. This was 3 years before we even launched Kiva Capital, our asset management wing, and then 5 years before we launched the Kiva Refugee Investment Fund. And so it took individuals putting more philanthropic capital, right, risk-tolerant capital that allowed people to take the leap and start lending to refugees and displaced communities on the ground. Fast forward to 5 years later, we had over $35 million worth of data, and it was the data that really allowed us to bring in an LP base and to crowd in more investors. That data showed that refugees actually repay their loans at the same or even higher rates than non-refugee clients. And so when we had that data point, we were able to say, there's not only a viable case to make in investing in refugees, there's a business case to be made to do so. And so with that, we turned away from just the philanthropic side of the Kiva.org crowdfunding platform and looked to bring in an LP base, brought in that LP base, and then leverage that with additional $21 million in debt. But it was that initial philanthropic set and the data that we developed and the track record that we showed in the viability and the business case to lend in refugees that allowed this then further kind of blending of finance to come in from there.
And unless, in case anybody thinks I'm crazy, saying in 5 years you're all going to go, oh yeah, refugee investing, remember the Grameen Foundation used data in a massive way to prove out microfinance, and that is no longer blended territory. That is an industry that no longer, and renewables, same thing.
Yep.
We all thought solar was crazy 20 years ago, and now in most cases it does not need blending.
And the more data we can have around what is a perceived risk versus an actual risk is what's going to help bring more blended structures into the space.
Yeah, because that was my follow-up question. What is still holding others back? Now you have the data and you have scaled, but of course the world needs more funding for refugees. So what's holding investors back?
Yeah, I mean, I think part of it is what Joan talked about in terms of the political reality today, and that some of the funding is drying up. And so as we think about as Kiva how we're going to grow and scale in this space beyond the current fund, we're going to need to do even more blending rather than less blending. What do we need in terms of a catalytic tranche to complement the LP base and the senior debt that we're bringing in to help overcome some of the drying up of capital? I think the other big thing, and this was talked a little bit about before, is also just the regulatory environment. We're investing across the Middle East, East Africa, Latin America in regulatory environments that differ greatly, and if anything are only getting more challenging, especially for refugee communities. And so Kiva at the end of the day is a drop in the bucket, right? We have a $32 million fund. We need more and more of us to come together, whether it's in the refugee space in our example or in other examples, to really work to change policy and regulatory environments on the ground to allow these funds to have the impact that they can possibly have if there's a more enabling environment.
Okay, thank you. And moving on to you, Timothy. As one of Europe's largest asset managers, Amundi has engaged in blended finance several times. And from your perspectives, what are the key, maybe 3 key conditions for making blended structures attractive and investable for mainstream investors like Amundi?
Perhaps before getting there, maybe pick up on some of Joan's and Lev's point to really underline why this is so critical, to really enable mainstream investors, mainstream responsible investors to step in. Because to your point, I don't think we'll stop at ODA, international aid. I mean, we don't know tomorrow what's going to happen to a certain number of UN agencies and their ability to just deliver their mandate. And I don't think it necessarily stops there. I mean, we could imagine very well multilateral development banks rethinking their mandate when it comes to climate change funding and social equality and environmental equality. And that's the case as well in Europe with development finance institutions. So it is a global challenge, and I don't think, unfortunately, it stops at ODS. So what does that mean for us and for the conversation we're having today is that, if capital stops flowing from one place, we need to think about the substitutes and the levers you can use to stimulate these substitutes. So that's really on the why and why this matters. And Lev, by the way, I love your example, because basically you're enabling, typical consumers, maybe it's just professional investors, you will tell us, but to chip in, and you go there with a compelling investment proposition. And to the mainstreamization, this is really what matters, I would say. To me, it boils down to 3 very basic criteria. Number 1, competitive risk-adjusted returns. To your point, I understand the focus on return enhancement, but to me, if you tweak the risk at a competitive pricing, it does affect the overall equation in a positive way, and it should suffice, number 1. But the second and the third items, usually people don't think hard enough about them. Low transaction cost, in the sense that people will not be expected to do a 6-month due diligence on any investment proposition, because most investors can't allow that. They simply don't have the bandwidth. It's not just retail. We're talking here about large insurance companies, pension funds. They don't have the resources to really spend months for their teams to look at blended finance versus a mainstream value proposition. So that's really, really critical. And the third, coming back to the standardization, sorry, that's really my focus of the year. To the extent possible, it needs to be an easy fit within investors' allocation. So the more you can move to a peculiar value proposition, to something that looks close to an asset class people are familiar with, the better it is.
So you answered this a little at the end, but how do you lower that cost on kind of that second point? Or where have you seen be most successful where that has occurred?
I've seen quite a few very, very, very interesting blended finance programs, and you've seen the same, and sometimes targeting billion plus, but it was super complex. Yeah. The way the insurance schemes were working, parts were funded, parts were unfunded. You have multiple layers of trenching. You had diverse source of funding. Some projects were benefiting themselves from a risk warranty and so on and so forth. And I would say the simpler the structure, the lower the transaction costs from a due diligence perspective.
No, I agree.
Big, boring, and repetitive.
Yes, I don't think big, bankers and asset managers like that, but this is what we need at the end of the day.
Timothy, when we talk about impact investing, we very often also talk about fiduciary duty. So can you elaborate a little bit on how you balance that?
To me, I don't think we should have that debate, actually. I think there is a continuum there, and depending on where the investors lie, what's their risk tolerance, what are their financial objectives, we need to be able to come up with the right answer. And then you will tweak the level of blending, the level of concessional funding, the level of cheap guarantee one needs to provide a compelling answer. So that's the first answer to that. And the second is, I think we should always engage investors. I'm talking here like we're an asset managers. We have discussion with clients and investors. What are your objectives? And we should start from there, and then we build the right investment proposition for them. And in most instances, it's of course a combination of financial return motives, as well as extra financial considerations.
Okay.
And the fiduciary duty is about meeting both, right? Not only one.
Thank you. And Ashish, we know that if we truly want to scale impact investing through blended finance, institutional capital is essential. With that in mind, could you share some of your experience with building capacity, both in national markets, but also specifically with pension funds?
Yeah, for sure. I've sat in roundtables and rooms, which is more about both training as well as master classes, where I have heard comments from, trustees at pensions there that one of them, actually US one said, in their internal teams, they're not even allowed to use the term impact investing because the way it's kind of seen as sub-market at the first place. So that's the starting point. Then I've been in sessions where, a lot of trustees who've been in the financial markets for decades, they had asked the question, okay, what is blended finance? So there's a spectrum. That is not to say that, that crowd probably is sort of diminishing in terms of how many people are not aware of it. But the way I frame it is like there's essentially two, sets of endeavors or initiatives that we need to do collectively. One is primarily external evidence building, which is a lot of research that has come out even today or over the last few years, which look at the risk return data from a number of impact funds, including a number of blended finance vehicles over the years. Some of them are showing encouraging, especially I could call out like private credit, as many of you have been are well aware that there's some data which shows like as compared to conventional strategies, some of the private credit have shown much less, let's say, default rate, like 1.52% versus 3%. I can provide you the specific report around it. So there's a lot of work around that external evidence building, which is already happening. It's not like something new. But the other pillar that I want to call out specifically is internal capacity building within a number of large institutionals, which is already underway. We at Pension for Purpose, we have been driving it through a lot of master classes, specific training for the trustees, and that is a slow transition. It's a slow journey. It can't happen within a year time. And my tactic over the years has been looking at finding those internal champions within those institutions and how you empower them with the right set of data and toolkit. So unless that behavior change internally happens to look at tackling the perception risk and building the internal structures to be able to look at purely exotic alternate strategies versus a passive listed equities, which can still help them meet their fiduciary duty very easily, rather than doing the heavy lifting of going into alternate EM facilities. So that internal capacity building through different sets of toolkits, different channels, different modalities is super critical. Now, looking at more from, let's say, UK pension perspective, I think we have talked a lot about headwinds. Let me give you one tailwind, if I can. There's a new pension reform bill coming in. The government is introducing there, which is looking at a lot of consolidation, especially in the DC Master Trust, direct contribution, master defined contribution. That's one. Secondly, there's value for money framework, which is coming out for pensions, which means like you have to prioritize performance over cost. Thirdly, there's this, the FCA, the regulator there, has come up with structures or promoting structures like LTAF, long-term asset funds, which will allow for them to do more illiquid, fully diversified strategies. And LTAFs are really suited for a lot of blended finance structures, especially from an institutional perspective. I think, and we are getting more and more sort of interest or request in terms of looking at these strategies that traditionally have not been. And over the time, I've seen how you really bring a number of, working with institutional managers to do a number of those trainings and strategies as compared to just focusing on very boutique, very plain vanilla strategies. So I think I touched on a few of those areas, and maybe I can build on some of them later.
Okay, thank you. And a follow-up, how can partnerships with local financial institutions or regional asset owners help bridge the gap between institutional capital and blended finance opportunities in emerging markets?
Yeah, before I answer that directly, let me highlight something on the perception risk, which, especially for EM, that is, quite sort of glaring. Some of you might be aware of the GEMS database from a number of DFIs and MDBs, Global Emerging Market Database, that tracked the loan book of these DFI MDB for 30 years. And they found out that the actual, let's say, implied default rate coming out is 4.4%, which is 70% less of what the sovereign ratings imply. So we need to tackle, through a lot of that evidence building, in these markets. And that's where a number of partnerships needs to happen at an ecosystem level, where blended finance is one aspect of it. When we say, how do you build the capacity of these, rating agencies to be much more accurate when looking at these markets? That's one. Then really when you look at, strategy like GSS, Green Social Sustainability Bonds, the role of regional financial institutions is super critical because A, they can tackle the currency risk, local issuance. There's more than $2 trillion lying in, let's say, African pensions, which for them, it's mostly going into currently in sovereign bonds there, very little to blended finance vehicles. So how do you sort of unlock those capital through the right layering of partnerships is super critical as well. And I think there's the early stage equity gap is still quite glaring in those markets. So you can't just expect that you will have quite a bit of scaled pipeline if you don't have early stage equity. So from a allocator perspective, especially foundations and philanthropic organizations, we need to plug that gap as much as looking at really larger institutional sort of pipeline.
Okay, thank you. And an open question for whoever who wants to give a perspective. Are we asking too much of blended finance? Should we be clearer on when it should pioneer and when it should mobilize? And how do we match instrument to context?
Well, since I take most of the heat from people who say, blended finance has failed, maybe I'll take a starting dive at it. We're asking too much in the sense that blended finance became talked about when the Sustainable Development Goals were issued. And somewhere out there became the myth that that was going to be the source of the trillions, the billions to trillions that were going to solve all the planetary problems and the problems of mankind. It can't. Blended finance ought to be the vanguard and not the default mode for all of those amazing growth markets in Africa and Asia. To say that blended finance is the end game is to sell those people short and to sell that opportunity short. So I think blended finance has a role, like I said, on both ends of the spectrum. It can come up with new asset classes. Think about how many of you are familiar with debt for nature swaps or debt for X swaps, fill in the X. There's a lot of them out there. The first one we ever saw was $12 million. We actually gave a grant to the Nature Conservancy that took one of them up to $460 million in Belize. And now that's an asset class that people are familiar with. So there is a role at the bleeding front edge, and then there is a role for the mobilization. I don't think the same transaction can solve both. They both need to happen. They are not the complete story, and to ask that we all stay in blended format is wrong. Think about the opportunity set of a continent like Africa that has 600 million people who are not yet electrified. I don't want to sell you a sob story because the word yet means there's an opportunity. Think about the average age on that continent, somewhere around 20 years old. Imagine what those people are going to look like if somebody banks them. Think about all the growth markets in Asia. You got 400 million people in Indonesia alone. Half the mankind is over there. So blended finance has to be a step stool, not an end game.
Thank you. We only have a few minutes left. Sorry. I just want to go back to what you said, Timothy, about standardization, and you also mentioned data, Lev. So standardization is often mentioned as a pathway to scale. Do we have enough standardization? Is it easy to get data to back it up? So just quick, brief perspectives from the two of you.
I mean, do we have enough? No, but do we have some? Yes, and right, Convergence is a great place to look for that. We're a Convergence member for largely that reason. There's a ton of data out there. I think, to the point you made, one of the things we've intentionally done in our fund is crowded in as many investor types as we can. And we talked about this a little this morning.
You're talking about the one that you're raising now or that you already did?
The one that we already did.
Okay.
And we brought in investors as low as $100,000, even though that was below our stated minimum ticket size. And that was because we didn't necessarily need that capital to close the fund, but we wanted to bring in as many diverse types of investors as possible, because that in itself is a success story. That's blending, even if we didn't have different asset classes in the fund itself. The fact that we have this diverse group of investors shows, I think, to what you were saying too, like there's a space for everyone in terms of the return continuum, there's a space in what we're doing for all types of investors, and the more we show that track record, the more we can help crowd in.
And maybe just to pick up on the example that you highlighted, I really like that example of Date for Nature swap. Why? Because you bring blending at like pilot micro project to an asset class where blending is still part of the value proposition, right? Because even for the 1 billion plus loan or bonds that you see out there, either on bank balance sheet or invested by pension fund and insurance company, there is a significant element of blending into it. And sometimes coming from DFI, sometimes coming from private philanthropic organization, together with insurance and reinsurance companies. So certainly a very interesting example from that standpoint, where it's not there in terms of where I would like it to be, in terms of being a full-fledged asset class. It's because it's still a diverse mix with loans, not necessarily bonds always. And if I had one call to Joanne and the blended finance community from where Amundi sits, is we need to have more focus on capital market instruments. Because the way to scale, the way to standardize, the way to democratize is through that venue for sure. And we need to keep working on the smaller funds as well. It's not either or, but we need to work on these capital market instruments.
Maybe one other thing to add. So if you look at blended finance products, which Joan knows well from Convergence, you have guarantees, you have subsidies, you have loans, and you have equity. And at InvestNL, we also advise our ministry a bit on how to, although it's on partial parts of their budget and not their entire budget, because it's not always useful, but how to put your money more efficiently at work and to get that return on investment to allocate it once again. And there, at InvestNL, we're looking at these research projects in different subsectors, where we look at what is the problem there, can we create a portfolio so we can create that standardization, and then have a diversified profile so the risk is manageable, and we can put that money at work, but then also expect it to come back again, because ultimately then you can move your money forward once more. And I think that's one of the really key elements that we find the most interesting about blended finance, is that segment where we can also have a return on investment that can make more impact another time around.
Thank you. Time is running, so I think I will just end this panel discussion by saying we have heard a lot of good success stories, and from what I took from it, it is we are able to scale it. So to you, I will say that we should not just leave here inspired. We should leave ready to act, to replicate, adapt, and scale what is already working. Because if we don't, we risk missing the window to reach the SDGs. But if we do act, the opportunity is huge. So let's go out and let's act. Thank you to you.